Hello and welcome. In this video, we will learn about intrinsic value and time value of an option. Alright? Now, in the previous video, I told you that the premium is made up of intrinsic value and time value. So, the sum of intrinsic value and time value makes up the premium. Now, what is intrinsic value? What is time value? What is the meaning? What is the significance? I'll explain everything in this video. Okay, so do not worry about it. Now, this intrinsic value for a call option is equal to stock price minus strike price. And intrinsic value for a put option is strike price minus stock price. Okay. Now, let me go to my desktop. Take an example and explain the concept of intrinsic value and time value. Alright? Alright. So I am on my desktop now. I have searched NSE option chain on Google and now I will go to the first result, that is by nseindia.com. I'll click on the link to go to this and now let me select a stock. Okay, let me select Apollo Hospital. Okay, let me select Apollo Hospital. Now, this is a stock and not an index. Okay, not an index. The last traded price of Apollo Hospital is this much. Or this is the spot price of Apollo Hospital stock. Or this is the stock price. You can call it the way you want. Okay. But this was the price of one stock of Apollo Hospital. Okay. So let me copy 4823 into stock price. Okay. I'll say 4823. Alright. 4823. Now this is the stock price. Next. Today is June 1st. The expiry of the stock options will be on the last Thursday of the month. So last Thursday of the month is 29th June and that is what you can see here. Expiry date is 29th June 2023. So let me have it here, 23rd June 2023. Okay, 2023. Now I have copied few details here. I have a table up here which I need to fill. Let me go here, explain some things and come back and fill this up. Okay. Now, once again, I am going to explain each and everything to you in detail. Alright. So, please watch this video entirely. If you do not understand, please rewatch it and everything will be clear to you. Okay. Now, let me go down. So, at the middle is the strike price. You know this. To the right of the strike price are the details of put options. To the left of the strike price are the details of call options. You know that too, correct? Now, the spot price or stock price is 4,823 and the strike price near to that or equal to that will be at the money. So, 4800 here is equal to or not equal to, almost equal to 4823. So 4800 will be at the money option. Okay, at the money option. So let me copy it down here. Let me copy 4800. Okay, strike price 4800 here. And let me randomly select two other strike prices on the upper side and lower side. So on the upper side, let me copy 4900 and 5000. Okay, so let me zoom it. Okay, so let me zoom it. Yeah, I hope it is clear now. Yeah, 4800. Let me copy 49 and 5000. 4900 and 5000 and 5000s. And on the lower side, let me have 4700 and 600. Okay, 4700 and 4600. All right. So I have 5 strike prices here. Now you can also do this along with me. You can open up an Excel sheet on your PC or Word document on your PC and do this along with me. Or you can take a book and a pen and calculate it manually. Okay, you can do that too. Now, for strike price 4800, let me see what or how much the premium is. For 4800, where is the premium? It is at the center, okay, LTP. So this is the premium. 157.95 is the premium for this strike price. So let me copy this 157.95. Premium is 157.95. Alright. For 4900 it is 110.60. 110.60. For 5000 it is, let me see, for 74 rupees. Yes, 74 rupees. Okay. Going below, 4700 is 216.75. 216.75. And 4600 is 290. So 290 rupees. Okay. This is the premium. This is the premium. Meaning, if I want to buy 5000 strike price call option, this is for call option, then I need to pay a premium of 74 rupees. Okay, 74 rupees. Of course, it will have its own lot size. So we have to multiply this by the lot size, but let us not go there now. It is not required for this video. Okay. Now, let me calculate this. We have our stock price here. Right? According to the formula, intrinsic value is equal to stock price minus strike price. So for 4600, let me first calculate the intrinsic value. So intrinsic value is stock price minus strike price. So I have my calculator opened up here. Okay, so let it be here. So first is stock price 4823 minus, this is the strike price 4600. Okay, 4600. So 223 rupees is the intrinsic value. So intrinsic value is 223. Okay, 223 rupees. Now, intrinsic value plus time value is equal to premium. Correct? Intrinsic value plus time value is equal to premium. Then what is the time value? Time value is premium minus intrinsic value. Correct? So 290, which is premium, minus intrinsic value 223 is equal to 67 rupees. Okay. So time value is 67, intrinsic value is 223. Now what is the meaning of intrinsic value? What is the meaning of time value? I will explain later. Do not worry about it right now. Okay. Now let me calculate for this. Okay. This strike price. Stock price 4823 minus strike 4700 is equal to 123 rupees, which is the intrinsic value of this option. Okay, this option. Now this is the premium. So this minus this will give me time value. So 216.75 minus 123 is equal to 93.75. Okay, 93.75. Next, let me calculate for this 4800. Okay, 4823 minus 4800 is equal to 23. So 23 is intrinsic value. Now this is premium. So let me do minus 157.95. This will be 134. Time value will be 134 point, how much is it? 95. Okay. Yeah. Now let me do for 4900. 4823 minus strike price 4900 is equal to, you see, we are getting minus 77. Remember that intrinsic value can be either 0 or positive number. So here we have positive numbers, but now according to our calculation we are getting minus 77. So this should be 0. We do not have intrinsic value in negative. Okay, 0. So what about time value then? You know that premium is equal to intrinsic value plus time value. If intrinsic value is 0, then the entire thing will be time value. So time value is 110.60. Okay. Next, moving here, 4823 minus 5000 is equal to minus 177. Once again negative value. So let me have 0, and everything is time value. Okay, everything is time value now. All right. Yes. So this is my calculation now. Now let me explain you what is intrinsic value, what is time value. Okay. Now see, this is at the money. This is at the money. For call option, this is at the money, and everything below the at the money is in the money for call option. Okay. So these two are in the money. Everything above the at the money are out of the money. So these two are out of the money. Okay. So I hope the concept of ATM, OTM and ITM are clear. Now today is June 1st. Let us say that I buy an option of this strike price. Okay, 4,600 strike price. Let me say that, or let us assume that I am the buyer of an option. I buy an option of this strike price, 4,600 strike price. When? On June 1st. Okay. The expiry is June 29th. But let us assume for this example that as soon as I buy this, the option expires. Okay. So morning 9:15, I have bought an option of 4,600 strike price. Let us say that as soon as I have bought it, the option expires. When that happens, when the option expires, how much money will I get? That is intrinsic value. Okay, that is intrinsic value. Now see, when do we buy call option? When we believe that the price will go up, correct? When we believe the price will go up. Now when I buy a call option, I have a choice of buying. Now I had bought this at 9:15, and as soon as I bought it, it expired. Now what is this strike price? What is the meaning of strike price? It is the deal price, meaning I have an option to buy at this price. So as soon as the option expires, will I go to the seller and will I say, hello seller, you see, I have an option to buy the stock at 4,600 rupees. So give me the stock. Will I say that? Of course I will say that. Why? Because the stock is trading at 4,823 rupees. The stock is trading at this much rupees, and I have a choice to buy at this price. Won't I do that? I will do that, correct? So by doing that, how much money will I get? I will get this much money, correct? I will get this much money. How? See, the stock is trading at this price. I have a choice to buy at this price, and if I buy at this price, this is the amount that I will be getting. How will I get this money? See, I buy at this price and I will sell at this price. So I will make 223 rupees, correct? Yes. So how much money do you get when the option expires is called as intrinsic value. Okay. Now to buy the option, I am paying the premium, correct? I am paying the premium. I am paying this much. By exercising the option, I am getting this much. So ultimately it is a loss. So let us not consider the premium paid. Okay, don't consider the premium paid. When you have an option and when you exercise that option or when you go for that option, how much money do you get? That is intrinsic value. Okay? Yes. Now, once again, let me take this example. Let us say that today on June 1st at 9:15 a.m. I buy this strike price by paying this much premium. Okay, do not worry about lot sizes and all. Okay, I buy an option of this strike price by paying this much premium, and let us say as soon as I buy it, the option expires. Now when the option expires, will I go to the seller of this option and say that give me the stock at 4,700 rupees? Of course I will say that, correct? Why? Because the stock is trading at 4,823 rupees, higher than this. I have an option to buy at this price. I have bought the option. I have an option to buy at this price. So what will I do? I will go to the seller and say, so give me the stock at this price. So the seller has to give me the stock at this price. And so I will be making this much money. How will I make this much money? I will buy the stock from the seller at 4,700 and then I will sell the stock at this price to someone else. So I will make this much money. Okay? So this is what intrinsic value means. How much money do you get if the option expires today? Okay, today, right now. Now, see, in reality, you are not going to the seller and buying it from him and then selling it to someone else. No, you are not doing that. That is used for calculation. Okay, that is the concept here. Alright, I hope it is clear. Now, let us come to this strike price. Let us say that I buy 4,900 strike priced option, okay, by paying this much premium. Now, when I buy this option, what is my expectation? That the price will go above this. That is why I have bought out of money option. Now, let us say that on June 1st at 9:15 I buy this option, and as soon as I buy this option, this expires. Now tell me, will I go to the seller of this option and say, hello seller, see, I have an option to buy the stock at 4,900 rupees. So sell me that stock for 4,900 rupees. Will I do that? No, correct? Why? Because the stock itself is trading at 4,823 rupees. Why will I go to the seller and ask him to sell it to me at 4,900 rupees? I can directly buy this, correct? So what I will say to the seller is, okay, I do not want to buy at this price. Let go of the premium. I am not worried about it, but I do not want to buy at this price. So I lose the premium and there is no intrinsic value too, because I am not going to buy it. Even if I buy it, I will be losing money, correct? Something is available in the market at this price. If I buy at this price, I will be paying from my pocket. I will be losing money, correct? And that is why there is no intrinsic value here. Same goes for this. Alright? So remember that at the money option, okay, at the money option and out of the money option do not have intrinsic value. It is only the in the money options which have them. Alright. So now here you are seeing 23 here. Here you are seeing 23, but we are paying premium, correct? We are paying premium of this much. So ultimately we are not gaining anything. We are not gaining anything. So at the money and out of the money options do not have any intrinsic value. ITM options have intrinsic value. Out of the money options have only time value. Okay, out of the money options have only time value. Now, assuming that you have understood intrinsic value, let me explain time value. What is time value? See, assume that you have bought this option, 4900 option. Okay, you have bought 4900 strike price option. Now, what is your aim? What is your target? What is your goal? Your goal is this stock moving above this, correct? According to your expectation, the stock price should move above this to make profit, for you to make profit, correct? So that is why you have bought this by paying this much premium. Alright. Now, sorry, this was supposed to be 29th. Sorry. Yeah, I'm sorry for this. Okay, sorry, this is 29th June. Alright. So let us say that, I'm stuck. Let us say that I buy 4900 strike priced option on June 1st. Today is June 1st. Okay. My expectation is that this will go above 4900, and only when it goes above 4900 I earn a profit. Now, how many days do I have for that to happen? How many days have I got for the strike price to move beyond this? I have these many days, correct? 2, 3, 4, 5, 6, 7 till 29. I have these many days to achieve the target. Current stock price is 4823. I want it to move above 4900, and for that to happen, I still have plenty of time here. I still have plenty of time, correct? And for that time, we pay a value called as time value. Okay? Time value is the value that you pay above the intrinsic value so that your target gets achieved. What is the target here? Target is that the stock should move above 4900. Okay, 4900. So for that I still have many days, and for that many days we are paying some money. We are paying some money. Okay, we are paying some money, and that is called as time value. Alright. Now this time value goes on decreasing, and upon expiry the time value will be 0. Alright, time value will be 0. So for example, just for example, if it was let us say 21st, today is 1st June, but instead of 1st June, if it was 21st June today, then to achieve this target, how many days do I have left? 1, 2, 3, 4, 5, 6, 7, 8 days, correct? 8 days. So the time is less there. So the time value will also be less. Okay? Time value will also be less. So that is the meaning of time value. Time value is the value of time. How much money are we paying for that time? Why do we have to pay for the time? Because the chances of me achieving the goal, or well, I am not achieving the goal, of course the stock is achieving the goal, the stock meeting my expectation is more. Okay, so if I have more time, the probability of success is more. and for that we are paying a value called as time value. Alright, so I hope it is clear. Now let me proceed to put option. Alright, so now we will discuss about put option. Okay, I have filled in all the details. Stock price is same, expiry is also same. I have copied the same strike price for this also and calculated all these details. Okay, I have taken the premium from right side of this page. Okay, right side of this page. Now the only thing that changes here for put option is the calculation of intrinsic value. Intrinsic value for put option is strike price minus stock price. For call option it is stock minus strike. For put option it is strike minus stock. Okay, so let me calculate for one and show you. So 4800 is the strike price. So 4800 minus stock is 4823 minus 4823 gives us negative minus 23. So minus cannot be an intrinsic value, and so everything is time value. Okay, everything is time value. Similarly, I have calculated all these values. You can do it too. Okay. Now let us try to understand the concept of intrinsic value for put option. Now, when do we buy put option? When we believe that the price will go down. Correct? Yes. Now, see, if I am a buyer of put option and I buy this strike priced option today, let us say that I buy this option today and it expires as soon as I buy it, will I go to the option seller and say that, hello seller, see, I have an option to sell the stock at 5,000 rupees. Will I do that? Put option means option of selling. If I buy this, or if I had bought this option and as soon as I had bought it, it expired, will I go to the seller and will I say, hello seller, I have an option to sell the stock at 5,000 rupees. Will I do that? Of course I will do that, correct? Of course I will do that. Why will I do it? Because the stock is trading at lower price. Stock is trading at lower price. I have a choice to sell at this price. Won't I do that? Of course I will do that. By doing that, what will I gain or what will I get? I will get this one minus this one, which is 177 rupees. Okay, 177 rupees. So that is the intrinsic value. How much money will I get if the option that I have bought expires today? That is intrinsic value. So let us take the example of this. Let us say that I am a put option buyer and I have bought an option of 4,600 strike price. What is my motive behind buying this? I am expecting the price to go below 4,600. That is why I have bought this. Okay. Now let us say that I have bought this and as soon as I had bought it, it expired. Will I go to the seller of the option and say, hello seller, see, I have an option to sell the stock at 4,600 and I want to do that. Will I do that? Of course I will not do that. Why? Because the stock itself is trading at 4,823. So why would I want to sell at lower price when I can sell at this price? Correct? So what I will do is I will say to the seller, okay, I do not want to sell at this price. I am okay with this being lost. So I will not exercise my option. That is what I am going to say. So the intrinsic value is 0 here, meaning if the option that I buy, that I bought expires today, I will not get anything. I will not get anything and I will lose my premium also. That is what intrinsic value means. What is time value? Time value is the value that you pay for the time, hoping that the price moves in your direction. Okay, hoping that the price moves in your direction. Now the direction that you want the price to move is down. Okay, whereas this here you are hoping the price will go up. All right, so I hope it is clear. As the option goes to the expiry, as it nears to the expiry, the time value keeps on decreasing. It is called as theta decay, which we will learn later. All right, do not worry about this right now. Okay, now if we consider same strike price option with different expiry, we can see the time value is greater in the option that expires next month. In this case, today is June 1st, and here I have selected the chart for 29 June expiry. Okay, and according to that, you can see for 4,800, 157 is the premium. Now let me change it to 27 July. Now if I go down for 4,800 strike price, you can see that the premium is 235 rupees. 235 rupees premium. I am paying higher premium for an option which will be expiring 2 months from now. Why? Why is this premium high? Because there is more time value. What is this time value? It is the value that you pay for time. Why do you pay value for time? Because you want the price here. If this is call option, you want the price to go up. For it to go up, still there is time. And for that time, you are paying money. Okay. If the time is less, then the chance of or the probability of the price moving in your direction is less. So the time value will be less. Alright. So I hope this is clear. So just know that the premium is made up of intrinsic value and time value. Intrinsic value is the amount that you are going to get if the option expires today. Time value is the value that you pay for the time, because it is helping you to reach your goal. Alright. So I hope I have made myself clear with the topic. If you have not understood, I would suggest you to watch it again. If still you do not understand, I want you to watch videos of some other creators, and I am hoping that it will be clear. Alright. So that's it for this video. I'll see you in the next video. Till then, take care and thank you for watching.